So it's February 9th, 2026, and global markets are flying, hitting heights that honestly feel a little dizzying. But after a run-up this incredible, the real question isn't how high we've climbed, it's how much longer the music can possibly play. In this breakdown, we're going to dig in and see what's really going on.
Right now, the market feels like this incredible party. The optimism around AI is just off the charts, and governments are keeping the stimulus taps wide open. But are we dancing in a brand new era of wealth, or is this the final, beautiful flame of a bubble that's about to pop? That's the big question we're unpacking today.
Okay, so here's the game plan. We'll kick things off by setting the scene today. Then, we're going to tear down the rallies in the US, Europe, and Asia. From there, we'll look at what the data models are predicting for the near future, and we'll wrap up with a potential strategy to navigate these crazy times.
So, let's get our bearings. What's the mood on the street? Well, it's overwhelmingly positive. You've got this huge US stimulus, the One Big Beautiful Bill Act, pumping cash into the economy, and just a global mania for anything and everything related to AI. It's basically the perfect recipe for sending asset prices into the stratosphere.
And wow, these numbers really tell the tale, don't they? The Dow is cruising past 50,000, the S&P 500 is right on the cusp of 7,000. But look, the real headline here is the Semiconductor Index, the SOX. That massive Dane shows this isn't some broad, healthy market rally. Oh no, this thing is being powered almost entirely by AI chips. And that, right there, is our first big clue that things might be a little off-kilter.
Okay, so that leads us right to the heart of it all. The US market. It's the absolute epicenter of this entire rally. So let's get our hands dirty and figure out what's really driving this thing. Is it as solid as it looks on the surface?
So, let's look at this through one lens, from economist Saifedean Ammous. He makes a really sharp point. What we're seeing might not be a boom in real economic value at all. Instead, it could just be an illusion created by monetary policy.
Okay, so what does that actually mean? Well, think about it this way. With the government printing tons of money and interest rates pretty low, the cash sitting in your bank account is losing its buying power every single day. That forces people to find somewhere, anywhere, to put their money to get a return. And where is everyone piling in? The hottest game in town, AI stocks. This is what's called malinvestment. Money flowing into things not because they're fundamentally sound, but just because everyone's running away from a dollar that's losing its punch.
And then you've got another heavy hitter, investor Ken Fisher, pointing to something else, a classic textbook warning sign. He says the market's breadth is narrowing. In simple terms, that means that even though the big indexes are hitting new highs, it's only because a tiny handful of mega-sized AI and tech companies are doing all the heavy lifting. It's like only 5 people are on the dance floor holding the whole party up. And it's not just opinions. The data models are flashing warnings too. The models that measure fear in the market are showing that volatility, the daily price swings, is super, super low. It looks peaceful, right? But any seasoned pro will tell you that when the market gets this quiet, this still, that's often when you need to start preparing for a storm.
All right, let's hop across the pond to Europe, because what's happening over there isn't one single story. No, it's more like a tale of two completely different economies heading in opposite directions all at the same time. It's fascinating.
And man, you can see this split clear as day. On one hand, you have Germany's DAX index just smashing through the 25,000 mark for the first time ever, really powered by its industrial muscle and stable energy supply. And on the other, you've got the UK's FTSE, which is barely budging, kind of stuck in the mud thanks to all the political drama and the lingering hangover from Brexit.
So why this huge difference? What gives? Well, according to Nobel Prize winner Simon Johnson, it really all boils down to one thing: stable institutions. He argues that money, capital, is like water. It's just going to flow down the smoothest, most predictable path. Germany, with its steady policies, is that smooth path. The UK, with all its uncertainty, it's like a path full of rocks and holes, and the money just isn't flowing there.
Okay, now for the part of the world where the party has gone from a waltz to an all-out rave. If the US and Europe are dancing, Asia is in a full-on sprint. The optimism here has shot past bullish and is now what a lot of people are calling straight-up euphoria.
I mean, just look at this number. South Korea's Kospi index jumped over 4% in a single day. It blasted through the 5,000 level for the first time in its entire history. And what caused this explosion? News out of Japan, a massive election win for a pro-stimulus party, which just sent a shockwave of pure optimism across the entire region.
Look, when a market moves like this fast, it's pretty clear we're not just talking about spreadsheets and earnings reports anymore. Scientist John Castiglione has a term for this: collective euphoria. It's a social thing. The optimism itself becomes contagious, creating this feedback loop that pushes prices way beyond what anyone would call rational. It's an incredibly powerful force, but a really dangerous one too.
Okay, so we've got euphoria in the US, a split personality in Europe, and an absolute mania in Asia. What in the world happens next? Where is this all heading? Let's take a look at what the quantitative models are predicting for the next few months.
What the models are basically showing us is a story in 2 acts. Act 1, one last absolutely massive surge higher, a super spike, as every last drop of optimism gets squeezed out of the market. But then comes Act 2. That final push is expected to be followed immediately by a sudden, sharp, and dramatic spike in volatility. The calm is going to break.
And here we can put some rough numbers to that forecast for the end of February. But look at the predicted ranges here. They're huge. The S&P could push past 7,100 or drop back down to 6,800. The Kospi could hit 5,500 before pulling back. The big takeaway here is the sheer width of these ranges. It's screaming potential for one last blast-off, but also the risk of a really sharp, sudden drop.
So that's the billion-dollar question, isn't it? How on earth do you navigate a market that could shoot higher right before it falls off a cliff? Well, the analysis points to a strategy with 2 parts. You ride the wave for as long as you can, but you keep a heavy anchor ready to drop at a moment's notice.
The core idea here is something called the barbell strategy, and it's pretty clever. Instead of building a balanced portfolio that's stuck in the middle, you go to the extremes. On one end of the barbell, you have your really aggressive, high-growth stuff, and on the other end, you have your super safe, defensive assets. You avoid the mushy middle completely.
So let's break down what that actually looks like. 60% goes into those aggressive assets. Think the AI leaders and solid German industrial companies to ride that final wave. But, and this is crucial, 30% is your anchor, safe stuff like bonds and gold. And that last 10%, that's your insurance policy. Things designed to actually make money if volatility goes crazy or the market drops.
Now, this is the hard part. A strategy like this takes serious discipline. The idea is to use simple technical indicators to give you signals on when to stay in and when it might be time to get out. But look, out of all these, step 3 is the one you absolutely cannot ignore: a strict stop loss. That means you decide beforehand the exact point you'll sell if a trade goes against you. In this kind of market, that's your emergency brake.
And really, at the end of the day, it all comes back to that central metaphor, doesn't it? The market isn't some perfect logical machine. It's a dance. It's this big, beautiful, and sometimes totally chaotic waltz that's driven by human fear and greed, by government rules, and by these huge waves of money sloshing around the globe.
So here's the final thought I want to leave you with. Right now, the music of this incredible bull market is still playing, and it's a magnificent dance to watch. But no waltz goes on forever. So the question for you is, while you're enjoying the party, are you keeping a very clear eye on where the exits are?